Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning into our MMG weekly recap. There's a trend developing right now, or has developed, that we want to make you aware of heading into the spring market. And there's one word, it's called complacency. So we're going to talk about the charts and the price action, because it really does highlight the complacent nature of the bond market right now. You can see we are moving pretty much in a sideways trend. Volatility has gone away a lot, and we are right now, again, on the right side of the chart, right near 2019 highs as it relates to price, which is also one-year highs in price. And at the same time, we're watching stocks power higher. So you have this beautiful market of people's 401ks and portfolios moving higher in value, and you have interest rates moving sideways in a beautiful trend. Well, why? Let's take a look back. Back in October, November, the Fed was very, very hawkish. They were talking about hiking rates 3 times in 2019, reckless abandon. We talked about it, said it can't happen. Well, they did a 180. And since December 24th, stocks have been in a rally mode. Why? Because the Fed was pretty much out of the picture. They're sitting on their hands right now, waiting to see what happens with the global slowdown. And then the second thing is inflation. We talk about inflation a lot. Inflation is the driver of interest rates. And you can see after peaking out, this is CPI. You can see here in recent months, that has ticked down. You could see the trend here in recent times is lower, or the rate of inflation is slowing. Disinflation is kind of kicking in. And we're seeing that around the globe. So there's a search for global yield. That makes the U.S. Treasury market kind of attractive compared to other bonds around the country. It also makes mortgage-backed securities rather attractive. It also makes stocks with high-yielding stocks attractive. So right now, with low inflation, a Fed out of the picture, and interest rates stable, that's keeping stocks moving higher. It's keeping bonds at an elevated level, but it's complacent for now. What will be the trigger? What could change this story? And it will be inflation. And so what we are watching are wages. It's the one piece that is starting to emerge that the Fed has always looked at and saying, it would be nice to see wages grow. Well, they're growing. They're growing at 3.4% year over year, the highest in a decade. And so there are feelings out there, and something we need to watch carefully, that if we get one inflation print higher, sparked by wages, and it could certainly happen, and it could happen in months ahead, this complacent trend will end like this. So we need to be mindful in the months ahead. We're watching inflation carefully, but right now it is low to non-existent threat, and that is really fueling this beautiful, let's call it complacent trend in interest rates, where we're moving sideways at the best levels in a year. I hope you have a great day. We'll be back at it next week. Bye for now.